Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel, the second one of its kind or a similar format for the degree of leverage. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side, including the break-even point. We're going to have the degree of operating leverage for two kind of calculations for the number of units at 25,000, the number of units at 40,000. Then we'll have a contribution margin income statement. We'll calculate the degree of financial leverage based on it. Another contribution margin income statement based on a larger number of units, where we will calculate the degree of financial leverage, and then we will calculate the combined leverage under the two scenarios. Let's go all the way back to the left. We're going to take a look at our data, starting with the break-even point calculation first. So we have the sales information, the fixed cost, the variable costs, which we're going to break out now into the number of pounds that we're going to be needing per unit and the cost per pound. So we've broken out our materials down a little bit further than we have seen in the past. The break-even point in units is what we're going to calculate here. Calculate the degree of operating leverage. We're then going to do that for two levels of sales capacity, that being 25,000 and 40,000. The annual interest is the 12,000. Let's first calculate our break-even point, which we've seen many times. That's going to be the fixed cost divided by the contribution margin in units. So the fixed cost is going to be equal to then the 230,000. We then have the contribution margin in units, colon, then the unit price, which is going to be equal to, I'm going to bring this in the inner column, that's 25,000. We then have the unit cost. We can even, the unit, we can say variable cost, which is going to be equal to, we're going to have to multiply these two together now because it takes 45 pounds per unit times the cost per pound, which is 25 cents. So that's going to give us our $11 per unit. Underlining this, Home tab fonts group underline, that's going to give us our contribution margin. Contribution margin in units is then going to be the 25 minus the 11. That's going to give us our 14. That's going to then give us what we need to calculate the break-even point in units. And that's going to be then equal to the 230,000 divided by the 14 to give us the 16,727. That's how many units we would need to produce in order to break even. Now we're going to be considering these 2 points, 25,000, 40,000, both over the minimum of the 16,727 in order to break even. Let's put an underline here, Home tab font group underline. Now, as we consider this, you kind of want to think about how far away we get from the break-even point when we start to think about this leverage calculation. So leverage, when we think about leverage, operating leverage and financial leverage, leverage can be both good and bad. More leverage brings on more risk, but it can also multiply the rewards and the gains. So as we move away from the break-even point, then we'll see the effect on these kind of leverage calculations for operating, financing, and then the combined leverage for the two. Let's start off with the operating leverage. Let's go ahead and hide some cells to do this. Let's hide the break-even point at this point. Let's hide from D to G. So let's go from D to G, DEG, from DEG, and then right-click on the selected area and hide it. And then we'll go to our degree of operating leverage, which can be calculated as contribution margin divided by the operating income, otherwise known as contribution margin divided by the contribution margin minus the fixed cost, one way to calculate the operating income. And we can also see that in terms of a formula, which is what we will be using, the unit price minus the variable cost, contribution margin per unit, in other words, times the number of units we sold divided by that same thing, contribution margin, which is this first half, minus the fixed cost, which is the operating income. Or we can do it with the percentage method. We'll do that in a future presentation. This is an alternative method which we may use if we don't have the internal data in terms of a financial statement or income statement with a contribution margin format, but rather a normal income statement, sales minus cost of goods sold, gross profit, and so on in that format. Okay, so we're going to calculate the numerator first using this formula. I'm going to start with X, which is the number of units. And remember, I'm going to do this in a tax return kind of format, so I think this is useful to break out in the in the final row or column here, this is where we want to finally get to our numerator and denominator, which we will divide out to finally get to, in other words, contribution margin divided by the operating income. So we're going to start off with the contribution margin, colon, and we'll start off with the units sold. So the units sold are going to be then, we're going to pick up the 25,000. That's going to be the 25,000 here, and then we'll do the 40,000 later. So that's X in our formula. And then we're looking at the contribution margin per unit, which is the P minus the VC, which is otherwise known as the contribution margin per unit, colon, which is the unit price less the unit costs. That's going to give us our contribution margin per unit. So then the unit price is just simply going to be that $25 per unit. The unit cost, a little more calculated or a little more complicated. That's the 25 cents per pound times the number of pounds that we need, which is 45 pounds per unit. And that's going to give us our $11. If we then subtract this out, the 25 minus the 11 gives us the contribution margin per unit of $14. Let's put an underline under this 11, Home tab font group and underline. And there is our contribution margin. And that'll give us then our total contribution margin. So the contribution margin in the outer column is going to be then equal to the 25,000 divided by this 14. And divided by. Multiplying here, multiplying. This is going to be the 25,000 units times the 14. And we get the 343,750. Let's put an underline here, Home tab font group underline. Let's do some indentations. I'm going to indent this entire thing. Home tab alignment indent. I'll indent these because I have another colon here, so that's usually an indication. So I'm going to go Home tab alignment indent. And then I'm going to indent this one again, Home tab alignment indent, and then I'll indent this one 2 more times. Indent, indent, something like that. Maybe went a little overboard on the indentations, but that's okay. Then we're going to go to the bottom half here, which is the contribution margin minus the fixed costs. So we can do that calculation, which is operating income. So we already have the contribution margin because we calculated it up top. So the contribution margin then is equal to this 343,750. And then we're going to be picking up the fixed costs. So those are up here. Those are fixed in our data. That's going to be the 230,000, 230, and that's going to give us our contribution margin minus the fixed costs, which is going to be equal in the outer column, the 343,750 minus the 230,000 for 113,750. Let's put an underline here, Home tab font group underline. Let's put an underline here. We're getting to our final calculation, which is exciting, that being the degree of operating leverage. And that's going to be equal to then the numerator, the contribution margin divided by the denominator, the operating income, giving us 3, but we're going to add some decimals to it by going to the Home tab font group, adding a few decimals. We could keep going. We're going to stop at 2 because we traditionally do. That's just what we normally do. Okay, so now we're going to do the same kind of thing, but now we're going to do it for the 40,000 units. So I'd like to copy this over, this whole thing, I'd like to copy it over. And I would like to be taking anything that's coming from my data over here, I would like it to be able to copy over here the same. Anything that's not coming from the data that is internal to the form, I would like it to transfer over and have a same relative formula. So that means anything that is coming from the data, I want to make an absolute reference, in other words, and then I'm going to copy this whole thing over. Or I might do it a little bit different than just copying it, but let's check it out. We're going to double click here. That's coming from the data. I'm going to put an F4 on the keyboard, making it an absolute reference, meaning $ before the B and the 13. Double click in here. That's coming from the data. I want to make it an absolute reference. F4 on the keyboard, $ before the B and the 3. This one, double click, and that's coming from the data. $ before the B and the 6. By selecting F4, I'm going to put my cursor in the B7. Select F4, $ before the B and the 7. This one, all internal, so I'm not going to do anything to that. That's not coming from the data that's in the form. This one, not coming from the data, it's in the form, so I won't do anything to it. This one is coming from the form, not the data, so I'm not doing anything to it. This one, It's coming from our data. So I want to F4 that one, making it an absolute reference, or in other words, putting a $ before the B and the 4. This one's coming from our forum, not from the data, so I'm going to keep that as is. This one's coming from the forum, not the data, so I'm going to keep that as is. Now I could simply copy and paste this entire thing, but notice I have some formulas over here too, and I don't want to absolute reference like the names. So what I'm going to do instead is I'm going to go over here and do a formula to pick up the names by saying just simply equals and then picking up the names. Then I'm going to autofill that down so all the names will be the same. Put in my cursor on the fill handle, dragging on down, and so there we have that. Then I'm going to copy all the numbers, and then I'll go back and format this a little bit more. So I'm going to copy all the numbers. I'm just going to select this entire thing, right-click and copying the numbers section, and then put that in 10 by right-clicking and pasting just normally, the normal paste, first one, or Control-V if you please. And then we're going to go ahead and format this because I don't have my indentations. So I'm going to format the whole thing. I'm going to use the format paint brush to do so. I'm going to select the entire region here. That's the entire region. Okay, and then I'm going to go to the Home tab, clipboard, use the format painter, the little paintbrush, and then I'm going to brush this entire region over here. And there, now we have the format painting has been painted. I painted the formatting on this one. Now we're going to just make the one change over here, which is that this amount needs to be then not the 25,000, but now the 40,000. So I'm just going to select over here the 40,000 instead of the 25,000. And there we have our change. Everything else remains the same. What's the bottom line effect on the degree of operating leverage? It has going down, which means there's less risk, less leverage. Why would that be the case? Because notice what happens as we increase and move away from basically the break-even point here, and we increase, we keep on increasing. What's happening is more of the costs are now moving from the fixed costs, which remained the same, to the variable costs, which are now going up in proportion to the sales. And because the fixed costs are the costs that create the increase in the leverage, that's where the risk is. Because if we were to decline, the fixed cost would not decline in proportion to a decrease. So the further away we increase away from the fixed costs, or the more the fixed costs become less material as compared to the variable costs, the lower the risk is and the less leverage we have. Conversely, you might say, well, if I had more fixed costs, maybe in some cases that would be good if that would generate more revenue, because it would possibly amplify the revenues. But in any case, the risk goes down. The leverage went down, meaning the risk goes down. Why? Because we're moving away from our total costs are now leaning towards the variable costs, because variable costs went up as total sales volume went up, whereas the fixed costs remained the same. Okay, so next we're going to be calculating and we're going to be making an income statement using a contribution margin income statement. We're going to hide some cells to get over there. So I'm going to put my cursor on H, on the column, the whole column here. I'm going to select on over to column P. Let's go to P. Right click, and then I'm going to hide those cells. So now we have our income statement. I'm going to make a contribution margin type of income statement, meaning sales minus variable costs as opposed to sales minus cost of goods sold. It's going to give us the contribution margin as opposed to the gross profit. Okay, so we're going to start off with the sales here. So we're going to say sales. We're going to calculate the components of the sales, which is going to be the units sold and then the unit price. And that's going to give us our total sales. So the units that we're going to be selling here, we're going to say that we sold 25. We're selling 25,000 units. We'll start there, and then we'll go to the 40 later. The unit price is going to be then this $25. That's the sales price. So if I sell 25,000 units at the $25, that's going to give us then the $625,000. Let's select these three items, do some formatting, going up to the Home tab, the alignment, increase the indenting, then the sales, Home tab alignment, increase the indenting, underline under the 25, Home tab font, and underline. Then we want the variable costs, colon, which is going to be the units sold time, and then the variable cost per unit, and that's going to give us our total variable cost. variable cost. And so let's do that. We're going to say the units sold, then is going to be that 25,000 again. And then the cost, it takes 45 pounds for 1 unit, and each pound costs 25 cents, we figured out. And so that means that it's going to be $11. So then if we multiply those out, the 25,000 units times the $11 for the variable cost, that's going to give us the 281,250. Let's put an underline below the 11, home tab font group, and underline there. Then we're going to be picking up the contribution margin, or total contribution margin. We can now calculate as the total sales minus the total variable costs. Put an underline under the variable cost, home tab font group, and then placing the underline there. Then we're going to be picking up the fixed cost. Let's do that with a formula. I can say this is going to be equal to the fixed cost up top. That fixed cost right there, those are the ones that don't change as the increase and decrease in the volume of sales changes. And we're going to put an underline there, home tab font group. Let's put an underline. That's going to give us our earnings before interest and taxes, which is going to be equal to the contribution margin minus the fixed costs. Then we have the interest. So the interest expense, which is going to be this 12,000 over here. And that's going to give us our earnings before taxes is going to be equal to the earnings before interest and taxes minus the interest. Let's put an underline over here, home tab font group underline. And that's kind of where we stop because we don't have the taxes, but next we would have the taxes if we were doing those, but we're not going to do that. And earnings after taxes, or otherwise known as net income. Okay, so now we're going to be calculating the degree of financial leverage, which is simply the earnings before interest and taxes divided by the earnings before taxes. Or we can use the percent method. We're not going to be doing that. We're going to be using our calculation here, fairly straightforward. We're going to be picking up the earnings before interest and taxes. Notice that sometimes you might not have that number. You might have net income, and you'd have to add back in the taxes and the interest, right? Which wouldn't be too complicated. You'd start at the end and add them back in to get the earnings before interest and taxes, which would then be equal to this number. And then we're going to be picking up on the bottom side, also known as the denominator, the earnings before taxes. So the difference between these two numbers being the interest, that's why it's the financial leverage. We're dealing with that, the rent on the loans of the money, interest. And then we'll divide those two out. This is the 113,750 divided by the 101,750. Let's add some decimals here. We're going to go to the home tab, the numbers group, add in a few decimals. We could keep going, but I'm going to keep it at 2 because that's what we normally do. That's only 1. We need 2. 2 decimals. That's our convention. So that's going to be the degree of financial leverage that we have right there. Let's put an underline, home tab font group, and underline. So the financial leverage, of course, dealing with that interest, which deals with the loans, how much financing we have. Once again, like all leverage formulas, as it goes up, the more leverage we have. More leverage means that we have more risk in case of a downturn, and we also could have a more multiplier effect on rewards in the case of an increase, good times. So good times could amplify the pain of the bad times. Now what we want to do is do an income statement, but now use the other units, which I think were 40,000. So in other words, I want to copy this entire income statement over here and then just simply change these two numbers to 40,000. To do that, though, I need to have all my formulas pull over. So I want to check if these formulas are coming from the data. Once again, if they're coming from the data, absolute reference them. If they're coming from within the document, then I do nothing because I want to pull over the relative formulas. Let's check them out. Double clicking here. That's coming from the data. So I'm going to absolute reference by selecting F4 $. What happened? F4 $, before the B and the 13. This one's coming from our data, so I'm going to F4 that one, $ before the B and the 3. This one's internal to the document. Nothing's going to be done there because of that. This one, I need to F4 that one, absolute reference, $ before the B and the 13. This one's coming from our data. I want to absolute reference both of them, $ before the B and the 7. Clicking here, $ before the B, in front of the B and the 6. This one is internal to the document, not going to do anything to that one. This one is internal, going to leave that alone. The fixed cost, that's coming from our data, so I'm going to put an F4 here, $ before the B and the 4. This one is internal, therefore nothing's going to be done to that one. This one is coming from the data, therefore I'm going to select F4 on the keyboard, $ before the B and the 16. This one is internal to the data, not going to do anything there. Now some of these references over here, like the fixed costs, are also coming from the data. I could make those absolute references as well, but rather than doing that, I like to just use a formula to pull over the names. Then I'll use the format paintbrush. So that's what we've been doing before. Same format, same reasoning. So I'm just going to say this equals the sales. Going to autofill that down, putting my cursor on that item and use the autofill handle to drag that on down. Like so. And then I'm going to copy the numbers. Let's just copy the whole thing. I can hit Control-C on the keyboard to do so. Control-C. Then move on over here and put Control-V, putting those numbers down. Then I just want to format paintbrush the entire thing. Format paintbrush, selecting the entire thing. Going to the Home tab, clipboard, using that good old paintbrush, format painter. And then I just need to click on that top right corner because it's the same area that we're paintbrushing. And then we have the paintbrushed formatting, which is really nice, except I didn't format these like we should anyways, like these three. So let's highlight. I'm going to select these three. Home tab, alignment, increase the indenting. Then Home tab, alignment, increase the indenting. Let's do that over here too. So these three. Home tab, alignment, increase the indenting. And this one, Home tab, alignment, increase the indenting. All right, that's better. Okay, so now we're going to be picking up this 25,000. I want to change that now. So I'm just going to say this will be equal to, scrolling on over because we're going to pick up now the 40,000. That's the only thing we're going to change. Now we're at the 40,000. This one's going to be 40,000 too. I mean, I said that's the only thing we're going to change, but we're only changing the 40,000, you know, the two 40,000s. You know what I'm talking about. So that's going to be it. We got now those two items have been adjusted. And that's going to adjust then our earnings before taxes now at the 308 as opposed to the 101,750. Of course, our variable costs are going up with proportion to the increase in the sales amounts up top, meaning we have an increase in the contribution margin. The fixed costs remained the same, which is important to note, as did the interest expense. So after having done that, now let's calculate our degree of financial leverage here after having made this change. So same kind of formula. I can actually copy the formula. Well, it's just, okay. It's the earnings before interest and taxes. So same calculation. Earnings before interest and taxes divided by earnings before taxes. The difference between those two numbers, the interest. This is going to be the degree of financial leverage. So we're going to be picking up then, this will be equal to the 320,000. This will be equal to the 308,000. We'll divide these two out, which will be equal to the 320 divided by the 308. Let's add some decimals, go into the Home tab, Numbers group, add a few decimals. We could keep going, but we like to stop at 2. So there we have it. Let's put an underline up top, Home tab, Font group, and underline. Now what happened here, the degree of financial leverage went down as the sales went up again. So it went down as the sales went up. That makes sense because we're focusing in on the relevance of this interest, which relates to the debt that we have, how much debt we have. And so even though the interest remained the same, the sales are going up. Therefore, the interest related to it, the debt related to it, is becoming less material. So you would think then the risk related to it would be going down, which would be indicated by the degree of financial leverage ratio going down. So once again, like the degree of operating leverage, if the sales are increasing and there's no change to the fixed costs as there wasn't to the operating leverage, then the leverage risk, the leverage number will go down. If there's no change to the interest or the loan amount or the interest related to it, then the leverage will be going down because the significance of the interest as compared to the earnings is now going down. So we have that decrease happening. Now we're going to go to the combined the combined leverage. I'm going to add another calculation. Now, there's a couple ways we can do the combined leverage. One is we can just multiply the two other leverages together, the operating leverage and the financial leverage. So let's do that first. That'll be like the first way to do it. So we got the degree of combined leverage. So I'm going to scroll all the way to the right. I'm going to unhide some cells. We got to unhide from B to R. So I'm going to select the column B. I'm going to go on over to R. So BRR selected. Right click on BRR and then unhide. And now what we want then is we want to make sure we're going to have to scroll all the way over here and pick up that 3.02 about. And then we want to make sure we pick up the right 2 here. And then we want to pick up the degree of financial leverage, the 1.12. So let's see if we can pick up the right ones with a formula. So we're going to say equals. I'm going to go all the way to the left with the arrows till we hit the wall. And then I'm looking for the degree of operating leverage in the first one that we did with the 25,000 units. That's going to be the 3.02. And then I'm going to multiply it. You can see the formula up top. I'm going to say times, and there's the times. I'm going to put my cursor back down because if I start hitting the arrows right now, it's going to take me back to the starting point. So I'm going to put the cursor back down, looking for the degree of financial leverage, the first one, which is right after the first income statement we did, which is the 1.12, and enter. That's going to give us 3. We're going to then add decimals, home tab, numbers, add a few decimals. We could keep going. We're going to stop at 2. Now we're going to do the same thing for the second one over here. So we're going to say, let's put our cursor here and do this again. I'm going to say equals, go all the way to the left, and then we're just going to hunt for this one. And then I'm going to hit the wall. I'm going to go right. I want the degree of operating leverage, but this time for the 40,000 units. So we want this 1.72 times, put the cursor back down so I can then scroll from this point, and then I'm going to go to the right. I want the degree of financial leverage, but not that one. I want the second one, the 1.04. So then enter. That's going to give us 2. We're going to put our cursor back on it. Home tab, numbers, increase the indenting. We could keep going. We're going to stop at 2, stopping at the 1.79. So there's our calculation here. And of course, the total combined leverage also going down as we had an increase in the sales volume, because both the operating leverage and the financial leverage went down due to operating leverage going down due to sales going up. And that means that the fixed costs are less as relation to total costs, variable costs more, fixed costs being less of a problem, less of a risk then, and the financial leverage going down due to the fact that the interest with relation to the sales has decreased as well, it then, of course, being less of a risk too. So then we can also calculate this in this format. We can take the contribution margin divided by the earnings before taxes. I'm going to try to do this without actually hiding any cells. So we're going to say contribution margin and then earnings before taxes. That's going to give us the degree of combined leverage. Now I'm going to pull these from the income statement, but I want to make sure I'm pulling it from the first income statement because there's 2 of them. So I want to say equals, and then I'm going to scroll to the left looking for the first income statement, not the second. There's the second one. I want the first one, and this is going to be the contribution margin. There it is. Contribution margin is going to be that 343,750 and enter. So there's that. Now I want the earnings before taxes. So I'm going to say equals. I want to get to that first income statement. There's the second income statement. There's the first income statement. We want the earnings before taxes. This is the one. We want the 101,750. So enter. Then I can divide these 2 out. This is going to be equal to the 343,750 divided by the 308,000. Then adding some decimals, home tab, numbers, add a few decimals. We could keep going. We're going to stop at 2. Let's put an underline up top. Home tab, font group, underline, and we have our same number calculated a different way. Amazing. All right, let's do it again because that was good times. So we're going to take the contribution margin. I'm going to say equals, and I'm going to pick up the same name here. I'm going to auto-fill it down using our fill handle. Auto-fill it down. I'm going to format paint the numbers. So I'm going to select these items. Home tab, clipboard, format paint, even before I put the numbers in, paintbrush it, so that the underline and the decimals will be there once populated. Now I'm going to pick up the contribution margin from the second income statement we were working with, equals. Let's scroll to the left to that second income statement. Contribution margin being that 550,000, there it is. Now I want to pick up that earnings before taxes from that second income statement, which is going to be on down here, earnings before taxes, 308,000, and enter. Let's divide those two out. This is going to be equal to the 550 divided by the 308. That's going to give us the 1.78. Once again, calculating it, the same number showed up in two different ways, which is amazing. Okay, so now we're going to go to the left. Let's just make sure that everything has been unhidden for us. And you may want to work with this and adjust the data over here just to see how the relationships between these items happen. You can see how the relationship between these calculations work.